Welcome to this explainer. Today, we're tackling what is honestly one of the most massive, systemic failures in the global economy right now, and more importantly, how modern technology is finally stepping up to solve it. We're talking about agricultural finance, specifically looking at sub-Saharan Africa. For decades, traditional lending has, it's pretty much failed the very people who grow our food. But think about this. What if the core problem wasn't actually a lack of money? What if it was a lack of trust? Over the next few minutes, we're going to explore how a completely new type of modern trust infrastructure is finally bridging that gap between smallholder farmers and institutional capital.
To really grasp the sheer scale of this issue, you just have to look at one staggering number: $117 billion. That's the estimated annual financing gap for agricultural SMEs and smallholder farmers in sub-Saharan Africa alone. It's an absolutely massive figure. I mean, global capital is abundant, right? Institutional pools run into the tens of trillions of dollars, yet it simply isn't reaching the fields where it's needed the absolute most. Millions of highly productive, totally creditworthy farmers are left fundamentally underfinanced.
This setup creates what experts often call the macroeconomic agricultural paradox. On one hand, you have the economic reality. Agriculture is literally the backbone of these economies. It employs about 46% of the workforce and drives anywhere from 20 to 40% of the aggregate GDP. But then, on the flip side, you have the capital reality. Despite being the main economic engine, agriculture consistently scrapes by with less than 3 to 5% of total commercial bank lending. So you have this vital sector experiencing deep, systemic capital starvation.
Section 1. The diagnosis. A crisis of risk legibility.
The crucial thing to understand here is that this financing gap, it actually isn't about a lack of risk appetite from commercial banks. It is fundamentally a crisis of risk legibility. See, financial institutions, they want to lend, but they simply can't read or quantify the risk of a rural farm using their traditional methods. Traditional institutional credit runs on formal paperwork, registered land titles, audited financial statements, historical transaction records, but rural agriculture in these regions operates almost entirely informally. So without those documents, banks are forced to rely on manual field visits and the subjective guesswork of loan officers. And that makes manual underwriting painfully slow, incredibly expensive, and highly subjective, which ultimately introduces a level of default risk that bank compliance committees just won't ever sign off on.
Now, early agtech companies actually tried to solve this. They used satellite imagery and black box AI to try and predict crop yields, but that completely failed to cross the chasm into institutional lending. Why? Well, because you literally can't hand a bank's risk committee an unexplainable neural network prediction. They need to know exactly why a decision was made. Modern credit risk committees absolutely require deterministic, physics-based modeling. They need a system that's auditable, shows clear mechanistic reasoning, and is fully compliant with strict global banking regulations, like the IFRS 9 accounting standard.
Section 2. The Bridge. Verdian's Intelligence Infrastructure.
To figure out how to build a bridge over this massive credit chasm, we really need to look at a platform called Verdian. Now, Verdian is not a direct lender, and it isn't just another farm management app. It's positioned purely as foundational trust infrastructure. Think of it as an integrated operating system built specifically for agricultural risk assessment. It takes the fragmented, informal biological reality of a rural farm and systematically converts it into the structured, lender-grade risk intelligence that a commercial bank actually requires to deploy capital with confidence. So, how exactly do they pull that off? Well, it happens in 3 distinct steps. Step 1 is simply collecting diverse, raw data straight from the field. Step 2 is absolutely critical, verifying the authenticity and provenance of that evidence so the bank knows it's 100% real. And step 3 is to underwrite the risk, generating structured, fully explainable credit scores. Let's look at how this builds up in practice. It all flows through the Verdian intelligence funnel. Raw, unstructured inputs at the very bottom, things like WhatsApp messages from farmers or telemetry from space, are refined through strict layers of verification. The system fuses these on-the-ground logs with remote sensing to build a compounding, highly verifiable intelligence layer. By the time all that data reaches the top of the funnel, it's been completely transformed into a definitive credit confidence profile.
Let's break down those raw inputs a bit, starting with WhatsApp. Verdian smartly meets farmers on a platform they're already using every single day. Through really simple chat interfaces, it captures photo proof, tracks input logs, and even maps GPS field boundaries. Crucially, this setup mathematically separates behavioral failure from constraint failure. Think about it. If a crop fails, the bank desperately needs to know, did the farmer just forget to spray their crops? or was there a massive regional drought? Differentiating between a bad farmer and bad weather is literally the key to solving moral hazard in unsecured lending.
And to actually verify that weather and crop health, the platform uses multi-sensor satellite data. It doesn't just rely on standard optical imagery, which, let's be honest, is completely useless during the cloudy rainy seasons, which happens to be exactly when crops actually grow. Instead, by fusing Sentinel-2 optical data with Sentinel-1 SAR, which is an all-weather cloud-penetrating radar, the platform monitors crop biomass and moisture stress continuously, rain or shine.
Section 3. The translation. Agronomy into actuarial science.
Here's the thing. Raw agronomy data, like soil moisture readings or biomass curves, is largely useless to a bank's credit committee. They speak actuarial science, not biology. This comprehensive platform architecture is what the bank actually interacts with. It translates those continuous biophysical signals into strict financial vocabulary. Bank underwriters use intuitive dashboards that automatically calculate things like probability of default, expected credit loss, and offer real-time portfolio monitoring.
And the ultimate output of all this complex translation is the Credit Confidence Profile, or CCP. You can think of this as the perfect replacement for that missing formal documentation we talked about earlier. It's a fully auditable, evidence-backed risk dossier. It gives the bank absolutely everything they need: identity, crop cycle status, climate exposure, all packaged neatly into a definitive IFRS 9 compliant credit document that just fits seamlessly right into their existing loan files.
Right at the heart of that profile is the proprietary 0 to 1000 Verdian score, which objectively weights all these risk factors. 35% of the score is based on actual biological crop growth, monitored straight from space. 25% accounts for climate and drought exposure. Another 20% evaluates the borrower's actual management behavior via those verified WhatsApp logs. And the final 20% confirms land tenure and GPS precision. It's not a black box. It's a fully transparent, highly deterministic score.
And because it's deterministic, it opens the door to live portfolio stress testing. A chief risk officer at a commercial bank can log in and run automated simulations against their entire agricultural portfolio. They can ask questions like, what happens to our default rate if there's a 15% drop in rainfall next month, or a 20% decline in commodity prices? They can foresee vulnerabilities and adjust their policies way before those risks ever become actual defaults.
Section 4. The Vision. De-risking the future of agriculture.
When we zoom out and look at deploying this trust infrastructure across the broader ecosystem, it systematically de-risks the future of agriculture. This kind of verifiable intelligence creates immense value for absolutely everyone involved. Commercial banks can finally deploy their abundant capital safely. Insurers get the exact plot-level actuarial data they need to write accurate crop policies. Governments and development partners can precisely target their climate resilience efforts using actual ground truth data. And honestly, most importantly, the smallholder farmers finally get to build an immutable, recognized digital credit history that truly unlocks their growth.
Ultimately, the core takeaway of this explainer really comes down to this one thought. Agriculture has not lacked data. What agriculture has lacked is an actuarial translator. The real barrier to feeding the world and enriching rural economies was never a lack of money, and it definitely wasn't a lack of satellite imagery. It was fundamentally a translation problem, and this modern intelligence infrastructure has finally solved it.
Which leaves us with a truly fascinating question to ponder as we wrap up. What happens to global food security and to the economic growth of entire continents when millions of historically unbankable farmers suddenly become a highly legible, verifiable, and investable asset class? By building this infrastructure of trust, we might just be unlocking the true potential of the world's most vital sector.